10-year note yield is at 4.84, so we're holding steady after that decline yesterday. Jim, that's really what this story continues to be about. Yes, we have the mega caps and the earnings that begin today with Alphabet and Microsoft, but we'd be having probably a different market picture if rates were still around or above 5%.
Yeah, I think you've nailed it. So far, earnings haven't mattered in the 2 weeks since we started, a little less than 2 weeks. What has mattered is geopolitics and interest rates. And interest rates have been defined, at least in large part, by the Fed moves. That's not the only factor involved with interest rates, but that has been a big factor, and it's been a big factor for the last 18 months, which is to say that the investing environment for the last 18 months has been lousy. Company reports, company earnings have not mattered anywhere near as much as interest rates. That will continue, in my opinion, my humble opinion, until the Fed signals that it's done raising rates. It sounds like, just listening to Jay Powell last week, like that's what he wants to do, Scott, but he's not going to declare mission accomplished too early. He doesn't want to take that risk. We've got a couple more months of what appears to be a kind of lousy investing environment,
Yep.
but when the Fed signals it's done, that investment environment changes.
Josh, Alphabet today, which you own, has been the crown jewel since the last earnings period. It's up 15% over the past 3 months. We've talked about new record highs that stock has been hitting. So what are your expectations here, and what do you think is really at stake for the state of stocks, given everything that's been going on and brings us to today?
Well, let me start with the last thing you asked me, the state of stocks. The forward PE on the S&P 500 is now 17.7. That's actually below the 5-year average of 18.7 and pretty much in line with the 10-year average. So the market is not particularly expensive. That being said, we have a little bit of an earnings problem. And if you pull out tech, this is another negative quarter overall for earnings, just for the entirety of the S&P 500. And even companies that manage to beat, GM is an example, which I'm sure Jim will do 10 minutes on in a second, it almost doesn't matter. The misses are being punished a lot more than the beats are being rewarded. That's just not a great environment for investors. Nobody feels good in that kind of an environment. To go back to what you were talking about, though, with Google, look, sometimes the market is more intuitive than others. Right now is one of those times. Why is Alphabet the closest to a 52-week high out of all of the FANGs? Well, very simply, they have the best earnings per share growth this year. Of all of the companies reporting, Apple's going to have 1% revenue growth, negative 1% revenue growth, 7% earnings growth. Microsoft is 8 and 12, not bad. Alphabet is 10 and 37, 37% earnings per share growth year over year in this quarter. That's why its stock looks the best. That's what investors are looking for. They want high quality, great balance sheets, big competitive moat, and earnings growth. And if you're delivering that, stock price is getting rewarded. Amazon's the wild card to me. I'm also in that one. We're expecting something like 10 to 13% revenue growth, depending who you talk to, but 107% earnings per share growth. They have drastically slowed down on spending. They're not trying to get the packages delivered to you in 15 seconds anymore. There's a marginal gain from doing that. I think you're going to see a bigger cash flow number here. The new CEO, the new guy, he's up against the wall. Those are the two. And I don't have an edge on which one will have the best reaction. I can just tell you, if either one of them were to sell off, I would buy both of them. So that's what, like, I have a game plan for the post earnings. I have no edge going into I have no idea. Neither does anyone else, but I admit it. Well, but those are the two that I'm a buyer of, no matter what.